Hey everybody, it's Brian Shannon from alphatrends.net. Today is Friday. It's the final day of October 2015, and the markets closed with a great month for equities. S&P 500 up 8.5%, the Nasdaq up 11.5%, and semiconductors gained some ground. Although this week they did slip, so the semiconductors are maybe telling us that things are a little overcooked here and may need to slow down a little bit. We did see the S&P and the Nasdaq and the Russell 2000 lose a little bit of ground this week. So let's take a look at the charts and see exactly where we are. We'll start out with the S&P 500, and we'll start with that daily chart where we see here, we had been speaking on numerous occasions of the potential level of resistance for this market, and we had identified, of course, the declining 50-day moving average, this prior level of resistance. We spoke about the declining 200-day moving average, and the fact is, the entire time that we've been rallying here over the last month, we've been looking at it and saying, we have to be cautious about this rally, but not to sell it short because these are only potential levels of resistance, and the market continues to advance above the rising 5-day moving average. Now, we have had a couple of examples where the market closed below the 5-day moving average for a day, but what we did not see was a flattening out of the 5-day moving average and then a pattern of lower highs and lower lows below it. That's what we'd be looking for a short sale, is the 5-day moving average to flatten out and then a pattern of lower highs and lower lows below it. By the way, as I'm drawing on this chart, I need to let you guys know about something that I'm going to be using a different charting platform in next week's video. Subscribers to Alpha Trends have seen me using that. It's much more intuitive to draw on and to put boxes on and different VWAPs and that sort of thing. Next Friday's video will use that. I'm really excited about it. It's got some great tools. So, and it's super inexpensive compared to Realtic. I've been using this Realtic for years, and it's tough switching a platform out, but I'm comfortable with it now, and I'm ready to share that with you guys next week. So keep an eye out for that. Anyways, the S&P 500, of course, we've got this right now represents the essence of trend, and we have next week, I think, is going to be an important level here at about 206. So, maybe we drop down to the trend line and this this little area of support on Monday or Tuesday. But then if we rally back up and fail to breach that 5-day moving average, so if the 5-day moving average flattens out and then we start to turn back lower, then the intermediate term trend will have turned negative. For now, we are still in a period of bullishness. We saw just a little bit of pullback here today. Nothing to be concerned about as far as that trend goes. We're still above the 5-day moving average, and more importantly, again, it's the 5-day moving average is rising. Even when we saw this little lower low, it was not enough to get bearish. What we needed to see was for the 5-day moving average to flatten out. So in order to see that support becomes resistance, and then a pattern of lower highs and lower lows below it. So let's keep an eye out for that next week. If we break below this 206-ish level, and not just straight down, but we to get bearish, we want to have a low risk entry, meaning we don't want to chase it after a drop of 1.5, 2 points. We want to see a little recovery rally, a lower high, and then a continued breakdown. But the market remains impressive. We are still also above that volume weighted average price year to date. So perhaps we get a pullback down towards that level, which was also these lows midsummer there in July. So, 204-ish, I think if we do see a bigger pullback, I think about 204 is a likely area for the S&P 500 to drop down towards. The NASDAQ 100 is in a much better position in terms of where we are. This closing high over here was 113.98, and actually this week we had a close of a new closing high at 114.02. So this market made a closing high this week, and actually even on a weekly basis, you can see the close back here in July was 113.58 was that 59 was that high close on a weekly basis. So it's tough to be bearish when we see that it's only closed higher on a weekly basis 1 week in the last what is this 10 years or so. So let's take a look then at the intraday. Here's a 30-minute time frame, and on this 30-minute time frame, you can see same story. We're holding above this volume, the 5-day moving average. This is the key level for next week that we want to see hold as a band of support. As long as we remain above that, any pullback should just be considered as a consolidation, not a reversal. But if we start to see a pattern of lower highs and lower lows below a flat to declining 5-day moving average, then we look at the intermediate term time frame and say now it's in a bearish mode, and where would it have the potential to go down to? Perhaps down to this trend line, which also closes this gap. That seems reasonable. The market is a little overheated, as we mentioned, so maybe back down towards 110. So it's time to be cautious. It's not time to be bearish. We are still going to see a lot of earnings coming out next week, and the Russell 2000, for its part, we broke the downtrend line and we broke above this level of resistance. Here's the issue with that on an intraday time frame. On the intraday time frame, we can see that we broke out, pulled back steeply, and then rallied over here. So at this point, it seemed like it should have continued to move higher, but then it broke below this higher low intraday on Thursday. At that point, we had seen we'd seen this peak, a lower high, and then a lower low. So now it's trying to consolidate here, and it's a little bit suspect. Let's look at the 30-minute time frame just to kind of frame it a little bit better. This had been the range that we have been involved in, basically this being the support down here and this being the band of resistance. Well, we broke above that, but we were unable to hold above it. And a breakout by itself doesn't mean anything unless it can hold. So next week, in order for the Russell 2000 to be in a position where it's able to continue to be where we can have a bullish outlook on it, it would have to get, I think, back above this 116 and a quarter to 116.25. So if we can get back above that and hold above it, then I think that the Russell 2000 could start to play some catch up with the rest of the market and perhaps head towards 120. So we're seeing a lot of mixed messages with these markets. Here I'm outlining the potential for bullishness in the Russell 2000, but right now it's looking like it has the potential to be a failed breakout as well. So it's going to depend, of course, on the other markets as well. And is the Nasdaq 100 going to be able to hold above this level? Is the S&P 500 going to be able to hold above 206? If they can do that, then it increases the likelihood that getting back above 116 and a half for the Russell 2000. But right now it's pretty murky, and we did lose some leadership from the semiconductors this week. Now, on the daily time frame, we've got a rising 10, 20, and 50-day moving average for the semiconductors. On an intraday time frame, what did we see here? Well, this is exactly what we're talking about. We broke a trend line, then we came down to the 5-day moving average, broke below it, and then we rallied up to it, and the 5-day moving average acted as resistance. So now we have a declining 5-day moving average, and we have a pattern that we need to see this market get back up above, I'd say, 55 to 55 and a half. Right now, as long as it's below 55 to 55 and a half on the intermediate term time frame, then we're looking at this market as guilty till proven innocent. It's in pullback mode. It doesn't mean it's a fantastic short sale, because we've still got a constructive pattern on the daily time frame, but expect that rallies, as long as we remain below 55 to 55 and a half, expect that the rally attempts will lead to failure, and breaking 53.50-ish in particular is likely to lead to a deeper pullback, and that may end up being what the catalyst for the Nasdaq 100 pulling back deeper is. The biotechs had a decent week here. Let's just take a look at that again. The biotechs were up 2.9%, bringing them back to positive this month with that 7.3% gain. They're now up 7.29% year to date, but there's obviously damage done here. We've got this market that's still below this trend line right here. We've got the declining 50-day moving average, and this market rallied into this prior band of support. So when we look at the daily chart of the IBB, which is the biotech sector, you can see intraday now that we broke beyond this band of resistance, and this is where we're going to want to see this market hold as support if this market has the chance of a bigger turnaround. Right now, we're looking at it as suspect because it has a declining 50-day moving average. On the intraday time frame, we're right at the 5-day moving average. So if we break down, we're going to test that 318 to 320, and how it behaves in there is going to be really the key for this group. I think for the next couple weeks at least. If we fail up here, then it puts a lot of pressure on that group, and we've seen, there's a lot of still a lot of uncertainty in some of the individual names. You've got this VRX, which closed at a new closing low here for the year, and a lot of little biotechs are starting to really get banged up as well, showing how risky that group really is. The oil bounced back a little bit. We'll just look at the USO. I mean, it's basically the same chart as oil, but we had seen that oil had been, and here's the thing that I talk about all the time, that we don't want to just short a breakout past resistance, and we don't want to short a breakdown through support. So that was, we don't want to just buy breakouts beyond resistance. We want to say, where has it come from first? So in the case of the USO, it dropped from 1620 down to 1420, so it dropped 2 points on a $16 item. So 24% basically, or I'm sorry, that's not true. 1/8 would be 12.5%. So it dropped 12.5%. So it had expended a lot of energy breaking down through there. And this week we got a little bit of a bounce. Oil is still kind of a mess, but maybe it's just starting to neutralize in here. You can see the 50-day moving averages begun to flatten out. We trapped the buyers up here. We trapped some shorts in here, and now it's maybe just time for that one to settle down a little bit. Apple, at Stocktoberfest a couple weeks ago, I had mentioned that getting above 113 would change me from bearish to neutral on this stock, and then it would depend upon how it behaved after earnings, whether or not this stock had the possibility of turning back to bullish. So we broke beyond that 113, and it held. Then we broke out here, pulled back, and then really got going nicely once again this week. So when we look at this on a year-to-date basis, you can see we're right at the volume-weighted average price year-to-date. That is a potential place where we're going to find some resistance. We also came up and tagged that 200-day moving average in Apple. So I would think that next week in Apple, we probably settle down a little bit. And if we can hold above 115 to 116, then this stock is doing a lot more healing and is potentially building the scenario for not only a break beyond and hold above that volume weighted average price and the 200-day moving average, but again, it's still murky with all this prior support over here. You have to ask yourself, why does support tend to act as resistance? Well, the longs who bought up in here and didn't sell on the way down might be saying, well, I'm going to wait till I get back to break even. People who shorted over in here are going to say, well, as it rallies back up towards there, let's defend our short position and offer more shorts out. And people in the sidelines in cash are going to reduce their demand for the stock because they say, well, I don't want to chase it here. It's up to this prior level of support, which often becomes resistance. So I think it needs some time really before you can take a longer term position in Apple. It's more of a, yes, it's turning more bullish, but for a longer term hold, I think that you've still got to look at it as it needs some work to do. I think it's out of the primary danger zone as long as we remain above 115. Breaking back below that would make this break higher suspect. But it's just one of thousands of stocks. There's plenty of others out there. Obviously, we talk about them every single day at Alpha Trends, identifying low risk, high probability trades. If you haven't taken a look, come take a look at get a free trial and see what it's all about. Thanks for tuning in.